Well, good afternoon, everyone. Thank you for those who have stayed. I know it's been a great couple of days. Thanks to Jeff and Kyle for having me come back for such a wonderful and worthy cause. Sadly, there is obviously lots of demand and needs to solve some of these issues. Okay, from a Wheelhouse perspective, when I was sitting here yesterday, I was very nervous that my face was going to be on the screen because, as you can tell, I need lots of beauty sleep. And the point being that the last couple of days, a lot of people have talked about lots of risks that exist out there in the world that can cause people to lose sleep. There have been lots of risks throughout my career, throughout history. And we designed a product set that's behind me on the slide deck to pretty much enable clients to have confidence that no matter what kind of really happens in the world, we're diversified and we have strategies that can grow, can protect their capital. And you see the track records in light of the volatility significantly in the public market that has taken place. We've been able to generate healthy returns. We're maybe a little different, especially, I listened to what I felt at times was a pretty misguided private equity panel just an hour ago, in the sense that volatility can actually be an awesome thing. If you're willing to take it on, you're willing to embrace it, you're willing to tweak your positions, right? You can take advantage of other people's fears and other people's nervousness. And the fund we have here, AmPlus, is a long-short credit fund. You look at those numbers, it's been the worst bond market of my career in the last 3 decades, and yet AmPlus has done pretty well, right? You look at Lions Bay, which is a long-short equity fund run by our teammates, and it had the best year ever in the volatility of 2022 when interest rates went up. And then Voyager Fund is a long-oriented, global, small, mid-cap fund that's also been taking advantage of the orphan status of people abandoning in droves the smaller type of companies. So where do I spend most of my time? It's not giving speeches like this. I love and I'm really passionate about, and for the last 3 decades, you'd be very hard-pressed to find too many other people that have met as many CEOs and CFOs from around the world, from really smart companies. And from that, we're doing bottom-up, hard-working research. But from a top-down perspective, we tend to identify trends and themes. And that's what's really fun, and that's what allows us in many ways to try and outperform the markets because we are so focused around the world. And so there's one simple idea from a high level before we get to our bottom-up idea that you're going to hear is going to come up over and over again in these slides that I'm showing you. And last night I was kindly invited to a dinner in conjunction with this conference. And I went, my 20-year-old daughter is in her third year at U of T Rotman at business school, and she had a finance exam. And so being a good father, I went, and because I'm worried about risk management, of course, for a day job, I decided to meet her at 10 p.m. last night outside the exam center at U of T campus. And we were walking back, and in anticipation of this, I actually asked her, I said, how many economics classes has U of T forced you to do as part of your undergrad? She said she's taken 5 courses in economics. And I have to be careful because my wife's an academic. And so I was like, 5 courses. And there was a really interesting book I read when I was 16 years old by a famous money manager, for those of you who are old enough to remember, named Peter Lynch from Fidelity. And the book was called One Up on Wall Street. And in that book, Peter Lynch said, if you spend 30 minutes on economics, you've probably wasted 20 minutes. And so, but for my daughter, what I try to say is, like, here, for everybody in the room, what was something I think was missing from the private equity panel is fundamental, bottom-up, economics 101. Demand goes up, supply goes down, right? You buy. What they can't do is what we can do. Supply goes up, and if we think demand's going down, you can short, right? And so that's one of the advantages that our products have been able to do, and why it generated those numbers that I showed you before. One of my mentors in the 1990s, made this comment that stuck with me throughout my career, which is that the most money goes to the wrong place at the wrong time. And so this chart's a little harder to see, but what you can see, that I found it interesting, the private equity panel is using numbers to show how they've outperformed markets during quantitative easing. I don't know, when I took my economics classes, there was no chapter on the books on quantitative easing. And now we're in a world with quantitative tightening. So I would say stay tuned with regards to valuations in the private markets, maybe. But what you've seen for those allocators in the room, I think being balanced makes sense, right? Those funds I had before, we call it pretty much the modern day balanced fund, right? But you see that equities, for the most part, and the bond market have been losing capital since the global financial crisis, as people have wanted to be, avoiding volatility, whereas I said before, Wealhouse loves to embrace volatility. So it's not lost to me when you look at this chart that the number of companies that private equity investors own keeps growing and growing and growing, and the age of those companies keeps getting longer and longer and longer. And so again, the supply of an asset going up, I would argue that perhaps, and we've all heard, there's somewhat been a bit of a hiccup with regards to demand. Yes, we're supposed to have the democratization of private equity in the years to come, and they're going to go after high net worth because, as we heard from one of the private equity allocators from the largest pension fund in this country, they're kind of full, right? So who's the marginal buyer is a question that we always ask ourselves when we're looking at an idea. And in this case, they're going to have to find new buyers, and it's not lost to me that LPs are limited partners as opposed to GPs or general partners. Limited partner by definition means you don't have a vote. Whereas in the public markets, we have a vote. We can vote proxies at annual meetings, or we can vote with our feet and we can get liquid, which has not been able to happen for a lot of people in the private world lately. So but then the great news, this slide really gets me excited because once again, supply is going down. We've seen a lot of difficulties for companies to get public. And one of the reasons for that is because of the exchange-traded fund phenomenon. So more and more capital has been allocated to ETFs, right? And so what that's caused is an inability for many companies to get public, because if there were 100 people like me running small mid-cap money in the world pre-2008, I don't know if there's 10 of us left, but it's definitely a market of investors that are declining, which is making it easier for us to find inefficiencies in the market, all the while people keep going more and more into the passives. And what that does is the unintended consequences. One of them is that the industry I grew up in, which was the mutual fund industry, has been under massive fee pressure, which means that these mutual fund companies have to get bigger and bigger in order to create economies of scale, right? And therefore, as they get bigger and bigger, it becomes harder and harder for them to go into the small and mid-cap area that we look to hunt. Again, I've long since used this slide, which I find interesting, is that the largest and most successful company in this country is Royal Bank, and the largest shareholder of the most successful and largest company in this country is Royal Bank. And then the other owners are the ETFs, the Vanguard, State Streets, BlackRocks, and then the other banks. It feels like that's getting a bit of a crowded opportunity set, and so I much prefer to be in a place where there's little more diversity of opportunity. And it's not lost to me that earlier this month, the CEO of Royal Bank, after we all went through the suffering of Christia's tax increase in June in this country, that the Royal Bank went a little unconventional and got quoted talking about some of the challenges in Canada. I titled this slide after our national anthem. It doesn't sound in a way I'm patriotic when I say instead of "Oh Canada," it's like "Uh-oh, Canada," right? And so he's, when you have the largest bank in the country who's talking negatively about the business dynamic, that gives one pause for thought. And you can look to the self to see what happens when you raise taxes or when tax jurisdictions become disadvantaged relative to another jurisdiction. So you see that California, or LA, has been the gift that keeps on giving to lower tax jurisdictions like Texas. And our investment we have today is an asset based, a company that has most of its assets based in Texas, which is a more business friendly climate. This morning, because just to make sure I'm keeping up with the IT panel, I did a chat GPT search and said which companies have moved their head offices from California to Texas. You've got this little company you might have heard of, reported results yesterday, called Tesla, right? You got this other great financial services institution that I remember meeting and traveling to see in San Francisco called Charles Schwab. You've got, in the energy complex, you got Chevron that was headquartered in in California. You got Palantir, which is doing pretty good in the technology space. You got Oracle. Anyways, the list could go on and on and on. And I think going forward, as there is a more tax-friendly, business-friendly movement, and sadly, as a Canadian, I was not happy to see. I'm worried that we are going to suffer the same fate as what you see there. Because when we talk to companies right now, we ask them where they have too much assets. Overwhelming, the number one answer that comes back over and over again, I got too much China, and I got too little Mexico, US, and India, right? I don't hear too often when I ask that question to all those CEOs and CFOs I meet before, that they want more Canada. And then the other thing, once again, supply in the public markets is shrinking. You see this chart here in terms of it illustrates the number of buybacks that are happening in the market. So as companies buy back their shares, can't tell you how many companies are out there that have bought back 20, 30, 40, 50% of their float in the last 5, 6, 7 years. That means there's less shares available, and so that's kind of why in some cases you're seeing a melt up in the market. Whereas it's not lost to me again that the private equity firms, thanks to a lot of your generous allocations, have all this dry powder. And what are we hearing? Like we heard on the private equity panel, they're going into the public markets to buy their assets. So they raise money, for a private equity, and then they're buying public equities. So, our fund, Voyager Fund, which we started in 2008 because we saw this trend starting to take place, has had 17 companies receive takeover offers since 2018. We've had 5 receive takeover offers this year, right? So I think the pendulum has swung in favor of the public markets versus the private markets. And when you study history, my wife's a historian, so she's trained me well to appreciate history. When you see an interest rate easing cycle like we've started in the US last month, we saw accelerated in Canada yesterday and other jurisdictions, small caps tend to outperform. The same thing can be said after the first Fed rate. And then within the sector, so the idea that we're going to pick today for those real estate public managers in the crowd, you're going to be happy. We've decided to be contrarians and pick a name that's from the real estate sector. It even does better than the overall market once you start an easing cycle. And so we think small caps are very undervalued versus large caps because of that. More and more money run by fewer firms. And then one thing, sadly, one reason why we had to see the Bank of Canada be aggressive at its easing policy yesterday is because we are seeing unemployment rates tick up significantly here in Canada, not as much yet in the US, right? And going back to AI, we don't know where AI will land in terms of productivity enhancements, but more and more companies that we've been talking to over the summer and the last couple of quarters are not having anywhere near the inflation problems, wage inflation problems that they saw the 2 years prior. So we think that foreshadows better times. Within real estate, we've all heard about the gating issues with BREIT, that big bad Blackstone, and they've managed that fairly well. But what you saw in 2023, the chart on the right, is a significant drawdown or a request from LPs for their money back. And so that's led to significant dislocations in the real estate market. And once again, the recurring theme is supply down, whereas demand is going up. We want to own those asset classes that have that phenomenon taking place. And here you see construction starts in the Sun Belt are starting to fall off a cliff, right? Because rates went up. And so yes, right, supply is high, so rents have moderated, but we think there will be a volatile experience and there will be an upside, and we will be in a position to invest, to trade that cycle on behalf of our clients. So, and then it's not, another point would be when you look at this chart, I find it interesting. We have doubled the population, so hypothetically doubled the demand, but we have not increased the supply of building homes in the US, right? So we think that's a good backdrop. So there's this huge shortage, that's a global phenomenon of a shortage of places for people to live. And so we think there'll be pricing power for the company we're about to recommend. And then from a valuation perspective, cap rates, because of all that money that came out of things like the BREIT, right, you've seen a significant expansion in cap rates or decline in prices or values. So we want to buy things when they're on sale, right? And you see here that, we think valuations have moved almost as much as what we saw happen during the global financial crisis. And, so let's get into rent potential or macro for this industry. The cost to own versus the cost to rent is very much in favor of renting, and so that will keep demand for people to stay in place in multifamily units and allow for absorption of this new supply. As evidenced by the fact today on Bloomberg, you see, housing industry has had some of the worst sales since the mid-1990s, right? And so we think it's still very, very expensive for people, even if the Fed cuts rates. There's a big debate, and I don't know where the rates are going to go, but we're far away from being able to allow people to leave to buy a home. There's also been some significant secular changes that I think are good backdrops and tailwinds for the multifamily industry. Like it's taken people a lot longer to get married than when I grew up, and then as well to have their first child, which means people will stay in place. And then you have, one of our analysts calls it the introverted economy. I was listening to the previous panel talking about people having chatbots as friends. That kind of further supports this thesis that people are living longer alone for longer and longer. So here's our idea. Our idea is a company called BSR REIT, trades on the Toronto Stock Exchange. It's headquartered in Arkansas. It's got mostly Texas assets as the biggest part of its NAV. We like the idea because since they went public before COVID, they've actually high-graded their portfolio. They've sold off a lot of assets in their secondary and tertiary cities and moved into more mainstream markets in Texas like Dallas and Houston and Austin. So they're improving their fundamentals in that way. And then, we also think that going forward, they have the ability to have higher rents. Like here in Toronto, it's not unheard of that multifamily companies will see their tenants have nearly 50% of their income tied to the cost of rent, whereas down in the Texas markets where BSR is mostly focused, it's still in the low 20s or even the high teens. And their balance sheet, they took care of their balance sheet. Usually public companies don't have as much debt as private companies, and so they've been able to weather this interest rate storm a lot better than what we've seen in a lot of the private asset classes. And then, right now we think the stock trades at about a 27% discount to net asset value versus the other publicly traded peers. And the implied cap rate is in the low sixes when the 10-year bond is very much south of that. So the spread is, there's positive leverage there for you to be had as an investor and much better liquidity. And, you get paid a healthy dividend while we wait for this supply to work its way through the system. And then when you look at, since it's been public, it's trading at the low end of the range based on price to earnings or AFFO and the price to NAV. So that's another reason why we're attracted to the name. And then when you look at their guidance has been growing their peer group, and yet their valuations are much lower than their peers. And another thing we think into the end of the decade, you see their payout ratio has been going down. So when rents start to come back as supply-demand equation turns in their favor again, they'll be in a position to grow their dividend, right? They astutely, wisely put a buyback in place when their stock got significantly discounted last year, and so we like the way management team thinks that way. And then, from a comparables, we always like to find companies that are cheaper than the market, growing better than the market, and we want growth, but we just don't want to pay a bunch of money for it here. And so you can see that their valuations are at a significant discount, and yet their rent has been outgrowing their peer group. And so we think that's a good deal and a good scenario for potential multiple expansion going forward. And and then from I'm a big, because I date myself maybe, I do believe in things like the intangible economy, but I also believe in replacement value when it comes to hard assets. And so their dollar value per apartment is 174. And obviously you might think maybe you haven't been there. I've been to tour these assets. I was down in Dallas with their chief operating officer, ex-CFO, Susan. And I went there, and the litmus test for me is, would it be a building that I would let my daughter, right, again, live in? And I felt comfortable as a bit of a helicopter dad, my story from walking her home last night. I think that their units are great. They have good security. You're not living in the hood with these. They've done a good job of using their platform to properly buy things. And then you have year to date, you've seen some transactions, mostly led by private equity firms, where that would validate the value per unit on this slide. And by the way, these slides will be available from my colleague Kaylee. And then from an average dollar per unit, as it goes up over time, we like charts, generally speaking, that go up and to the right when the valuations of the assets are increasing. And because we have seen, this chart, I'm forcing this chart in because it's one of my favorite charts right now, and it speaks to the fact that commodities have been trading at a significant discount relative to the rest of the market. There's been an under-investment in the commodity complex, and we think that, over time, I believe, and things revert. But these are all the inputs that go into building like an apartment, like wood and aluminum and copper. And so we think the go-forward supply-demand equation, if I had more time to talk to you, is very bullish there. And then we always want to try and figure out, are we ahead or behind? If everyone believes in the thesis, we want to be contrarian. That's how I've made most of my money in my career, is finding ideas that others people were abandoning. And right now the sell side, so we view in many ways, for my sell side friends in the audience, that we are investing against you. We're trying to get ahead of you. And after having high teen rent growth during the mayhem of the inflation spike in 2020 and 2021, the sell side has now got much more muted expectations. So we think the next couple of years, there's potential for exceeding expectations. And then rent per square foot, if you go and try to find a place to live here in the city within blocks, you'd be lucky if you could find a place for $3 or $4 a foot. Whereas if you go down to the States, you can still find things sell for $2 a foot that I think are of a better quality based on the firsthand tours I've done. And so we think their financial metrics will improve. And then this year, it was validation of our process. We've seen some companies within the real estate bucket get taken over. One, Tricon, which is a Toronto-based company with a lot of assets in the US and some multifamily assets here in Toronto, got a bid from Blackstone. And we don't make investments because we think something's going to get taken over. But I think this illustration where we've had two other companies in the real estate bucket get takeouts, and we've seen some other mergers of equals as companies try and get bigger and get economies of scale and synergies so they can qualify for these ETFs. That's one other phenomenon I think will very well. So I've seen some other presenters put up a disclaimer. I didn't do that. So this slide is my way of saying, I think you should be diversified. I reserve the right to change my mind if any of these macro risks were to change. I didn't talk a lot about disruption risk. That's something that we spend a lot of time looking at because, once again, if you own all those private companies, you're liquid, and someone does disrupt your business that you own, what are you going to do? Whereas us, as I said before, we can sell, we can vote with our feet, right? And then the story I'll leave you with, because it was mentioned before about Amazon. I was very lucky early in my career. I met Jeff Bezos when he was a private company. And I thought it was really neat because I like to read books. And I remember going back to my boss at the time and said, hey, we should buy that IPO. It's going to be really neat. If you had told me that, 25, 26 years later, I'd be sitting on the couch with my wife this past Monday watching the Toronto Maple Leafs on Amazon Prime, and then Matt Sundin would show up in the second intermission selling his book that he just wrote through Amazon, I would have been less surprised at Matt Sundin selling his book, but I wouldn't have known that I would have to hear my wife complain that some American commentator was having to call play-by-play on her favorite hockey team. And so the idea is we don't know what we don't know is going to come from AI. We have no idea. And it's just like I have no idea Amazon was going to do and become the platform that it became. There will be all kinds of opportunities, investments, inventions. There will be winners and there will be losers. And so I leave here. I got a couple of my colleagues in the in the audience. Kaylee, as I said before, if you're interested in seeing the slides in a less rapid fashion and take your time to read through them, happy to share them with you. I got Vishal who joined us. He helps me with helps us with risk management. And then we have Devin who graduated with a physics degree from Waterloo and has joined our team 18 months ago. And he's executive vice president of figuring out who's going to get disrupted in the future because I don't have a physics degree in my back pocket and he does. So with that said, thank you very much for listening to the idea. Thank you for having me here again. It's been great to see some clients that have trusted Wealhouse with their capital over years and meet some new relationships at this awesome event. And again, it just keeps getting better and better. And I only look forward to seeing what you put forth for everyone to get smarter at next year. Take care. Thank you.